Now, let me just clarify something so I don't confuse things here. The discount rate is the cost of debt for the tax savings, but the actual discount rate that's used for the rest of the cash flow, the terminal value of the forecast, is going to be the cost of equity. And in this case, the cost of equity is going to be usually the levered cost of equity, okay? Because the company has debt at this point. So we'll talk more about that in a bit. And the other thing before we do the forecast, I will use the formula for free cash flow, which is going to be important in both of these calculations. So free cash flow is equal to EBIT, so you take your earnings before interest and taxes, times 1 minus the tax rate, plus depreciation and amortization. You're going to add that back because it's not a cash flow item. And then you're going to subtract the change in working capital. And from that, you will also minus the capital expenditures that you have. So you can't just take net income on its own because that's not cash flow. You have to make some adjustments, adjust for non-cash items and take off taxes, and that's your free cash flow. Okay, so let's do an example of what's been given. This is from a slide. They started with giving you some assumptions and you had to calculate the growth rate in the forecast. I'm just going to take it after the assumptions are done and the forecast is created. So what they've done here is you've got the EBIT. So all of these items in blue are the numbers that are used as a basis for calculating the free cash flow. So this gets us our EBIT. And then they've calculated the net working capital. And what we want is the change in working capital, which is this line. And we're going to subtract that out. We're going to add back the depreciation, and we're going to subtract out capital expenditure. And this is the forecast for this company, okay, the free cash flow forecast. And what they did was they converted it to present value. So you use the present value using 8% discount rate. And how did they get that? That was given. That was your weighted average cost of capital, discounted it back, and essentially you calculate that this company, the cash flow, is worth $16.34 million. So that's the value of the cash forecast that the company has created. Now, what happens after year 3? The company is still going to have a terminal value because it's still going to be continuing on after the fact. And what they said is, in order to calculate the terminal value, and this is given in the question, so it's not written here, but I'll tell you how they basically said it. They said take year 3 free cash flow and it will grow by 2% per year forever. Okay, so what we're going to do in order to find out what's the terminal value at the end of year 3. So the terminal value at end of year 3 is equal to year 3 free cash flow times the growth rate of 1 plus 0.02, and then we're going to divide that by the WACC minus the growth rate. And that works out to 680 divided by the WACC was 8% and the growth rate is given as 2. So it works out to 113.39. Okay, so just to clarify, this growth rate was based on the year 3 number of 667, and that's going to be the value of the company at the end of year 3. So what's the present value of the terminal value? It's going to be 113.39 divided by 1.08 to the power of 3. So you're just taking a time value of a lump sum, and that works out to 90.01. So if I take these two numbers, then the value of the company which is the enterprise value, is equal to the present value of the cash flow plus present value of the terminal value. And we calculated each of these to be 1634 for the cash flow and 90.01. So we get a total of 106.36 million. And then we're going to take off debt. Okay, so we're going to take off $30 million. And just as reference, this is given in the question. We didn't calculate this. So if we take that, we get the value of the equity. So 76.36 million. And so the key here is you got to get the forecast, take a present value, then you got to create an estimate of the terminal value, take the present value, and that'll give you the value of the business as a whole. And when you subtract out the debt, you get the value of the equity. And if you wanted equity per share, you just divide by the number of shares outstanding.